Well, we're going to get rolling here this week. We've got the USDA report last week. We got the crop tour going on this week. But, as always, we try to just always take a step back from these markets and look at the big picture and see what's going on. So here are a few things that really stick out to us. Here's a December corn chart in front of us. And on here is the red lines at between 525 and 575. And we've had this chart up numerous times. And what sticks out to us here after last week's report is we got a bullish report, but we really could not break out to the higher side. That's got to be disappointing to the bulls in the market. Yes, that USDA report offers a layer of support, but again, it wasn't positive enough to get us breaking out. That's something that we need to be a little concerned with. When we switch over to the bean market and look at November beans, it's really the same read as corn. You got a little more of a positive report, but again, we're still just stuck in our range between $13 and $14. As we look towards the wheat market, though, in September Chicago wheat, you got a positive report, a surge higher. New contract highs were made last Friday, but again, we didn't get any follow through in here right now as we took out those May highs by just a few cents, but could not close above them. That wheat report gives some support. You have the world markets rallying, but we do need to question right now, do we have to go much above 760 or 770 on September Chicago wheat? As we look towards Minneapolis wheat, and which was the most bullish of them all, they again, like Chicago, made new contract highs and got above the late July high in here. But just like Chicago, it really lacks some follow through. So when we take a step back and look at the report from last week and look at how the markets are acting, yes, the reports are positive, but they weren't positive enough to send us into new highs. And with harvest fast approaching on both the corn and bean side of it, that is a little bit of concern in here right now. We want to take a look at a few of the outside markets in here because we think that's where the influence could be as we move ahead on the grains. And really it comes down to, is there enough news to get us roaring higher in here? Or is this news in the grain markets a little more stale? One of the hottest markets out there recently has been the oat market. As you can see by this chart, from just a few weeks ago, we were below $4 a bushel. And now we've got front month oats above $5 for the first time since 2014. Again, if you want to point towards a bullish market, it's oats that looks hot in here right now. $5 is probably psychological resistance. If this thing wants to continue to run, you can see the 2014 high was up at $6. Another market that's been pretty hot recently is the cotton market, as cotton futures made new contract highs in here this week. And as you can see, they're trading right up near the 2018, 2014 highs around 95 cents. That 95 cents to $1 area has stopped the market out before, except for in 2011 when that market got extremely hot and traded above $2. This is another market out there just like oats, okay, if you want to be bullish, pointing, hey, if we have the fundamentals out there, we have the bullish storyline, it's a market that has run. Another market that's been pretty hot is a coffee market, and we have the red line at $2. And as you can see, over the last couple of weeks, we've had the front month coffee market trade to its highest level in 2014. We have to attribute the strength in coffee just to the crop issues that we've seen not only on the corn and the bean side of it in Brazil, okay, but coffee as well. And therefore, you've had a market that made a really good run up. So if you're looking for increased money flow, if you have the bullish storyline, those are three commodities that have just made new highs, where at the same time, you've had the corn, bean, and wheat market fail. A market that is a concern of us, though, is when we get over to the lumber market. We highlighted lumber throughout the winter months as futures went to $1,000 in late 2020, pulled back, and then ran up to $1,700 a board foot here this past summer. But as you can see, as the news on the lumber side of it started to soften up a little bit, this market quickly rolled lower. Okay, we don't expect corn or soybeans or wheat to do the same thing as what happened here on this lumber market. Okay, but this is a concern of ours when you consider when a market does not have speculative interest and the speculators start going to the sidelines, how things can roll lower in a hurry. we want to wrap things up in here, and here's some final thoughts for us on this week. The first thing is we can't deny that last week's supply-demand report offered a layer of support underneath the market. But the way the futures market responded, it wasn't that bullish spark that was needed to go out and make new highs. We read the outside markets as a mixed bag. We gave you some bullish arguments out there. We gave you some bearish side of it. Here's the equity markets made new highs last week. They're softening up here this week. And the energy markets look a little bit tired in here. So, in the outside markets, okay, you can make an argument either way in here on how things can go. Our concern on the grain markets is pretty simple, okay? It's the large net long positions by the managed money. And as you can see in front of you, the corn contract, the specs are net long 254,000 contracts, soybeans a little more than 91,000, and Chicago wheat just less than 20,000 contracts. Where our concern comes from is that if this market becomes stale on news, and the speculators don't want to be involved, and they decide to liquidate out of their positions, we're going to roll lower on this market. Now, if this happens at the same time as harvest, or you get some increased farmer sales, that's when this market could break lower than what you would expect. Now, when we look at the supply-demand numbers, we could make a strong argument that corn's going to stay between a 525 and 575 range, or that beans are going to trade between $13 and $14 as we move ahead over the next month or two, okay? The concern, though, is in order for us to break out to the higher side, we need the speculators to buy more, and it just seems like we're running in towards the end of the year here where weather's not having the influence on the market as harvest is fast approaching, and we have had a pickup in demand on soybean side of it, but overall demand has been lackluster at best. So if we break out, we're moving into the time frame right now. Our fear is that we would roll lower solely on this spec liquidation. If you have some bushels you need to move at harvest, we encourage cash contracts. On the bean side of it, we like budgeting dollars for puts. On corn, we like looking towards the fence positions. A 540 or 550 put on D's corn, and sell a call above the market to help finance it. That's a marginal position, but again, that's something that you may want to consider. The other thing is look ahead to 2022, as we recently had July Chicago wheat trade above $7.50 a bushel. We believe that is going to attract world wheat acres. Again, there's a lot of moving parts in these markets. We're anxious to see how this crop tour shakes out in here at the end of the week, but as we sit here right now, our concern is new highs were not made with last week's report and the way the specs are sitting in the market. Any questions or concerns or comments, feel free to drop us an email. Thanks and have a wonderful day.